Welcome back to The Explainer. Today, we're popping the hood on the fascinating corporate mechanics of an iconic, 170-year-old American manufacturer. We're going to look really closely at Smith & Wesson to see exactly how a historic brand manages to engineer massive growth in the modern era.
All right, let's just jump right in with an absolutely staggering number, $523,845,000. That's over $500 million in full-year net sales for fiscal 2026. And honestly, what makes that figure so remarkable is that they pulled it off in the middle of a highly complex economic environment, battling inflation and wildly shifting consumer demand.
So, to figure out how this manufacturing giant actually operates, we're going to unpack their SEC filings by looking at their standout financials, their core business strategy, the innovation that's driving their revenue, their expanding product lines, and finally, the risks they have to navigate every single day to keep this machine running.
Okay, let's hit Section 1, a standout fiscal 2026, surging sales and strong margins. The top-line revenue numbers here are going to immediately grab your attention.
When you look at their recent Q4 earnings release, you've got to remember that this is a company that just navigated a massive logistical nightmare, relocating their corporate headquarters and manufacturing all the way to Maryville, Tennessee. Moving operations like that is notoriously difficult, yet they somehow executed their financial goals right alongside that transition with impressive precision.
Just look at this clean, side-by-side growth. In the fourth quarter alone, net sales jumped from about $140 million to over $178 million. That's a massive 26.7% leap compared to the prior year. At the exact same time, they bumped up their gross margins to 29.8% and basically doubled their GAAP earnings per share, going from 19 cents to 36 cents. It is literally a textbook example of operational leverage.
But here's the real kicker. In their sporting goods channel, handgun unit sales surged by 23.2%. Why does that matter so much? Well, broader market background checks, which are pretty much the standard proxy for overall industry demand, only rose 1.1% during that exact same period. This means Smith & Wesson vastly outpaced the broader market, which strongly points to them actively stealing significant market share away from their competitors.
So, how do you pump out numbers like that consistently? Let's move to Section 2, the core business strategy, creating a leverageable infrastructure.
If you dig into their 10K filing, it outlines this absolutely ruthless four-step operational machine. Step 1, push organic growth by leaning into their massive brand equity. Step 2, prioritize product quality and what the consumer actually wants above all else. Step 3, standardize the infrastructure. Think rolling out unified enterprise resource planning systems just to make them an easier company to work with. And Step 4, maximize return on invested capital. Every single dollar has a job to do.
And this right here brilliantly illustrates that capital allocation strategy in action. In fiscal 2026, they generated over $114 million in operating cash flow. With that huge pile of cash, they optimized their balance sheet by repaying $60 million on their revolving credit facility while simultaneously handing $23.2 million right back to their stockholders as dividends. They're literally funding their own growth while still paying you to hold the stock.
But here's the reality check for modern manufacturing. A legacy brand just can't survive on its history alone. That brings us to Section 3, driving revenue with innovation, the new product engine. The crucial takeaway is this right here. An incredible 37.5% of their total fiscal 2026 revenue came exclusively from new products. That is a staggering metric for a brand that's been around since 1852. It proves that they aren't just coasting. They're actively out-innovating their own legacy lines to make sure their catalog never goes stale.
Now, while they do manufacture a pretty wide variety of items, their agility in dropping new iterations of polymer pistols and revolvers ensures that handguns remain the absolute bedrock of their shipping volume. Making up over 80% of their total units shipped, handguns are for sure the vital heartbeat of this entire corporate machine.
Let's pivot from the macro-level financials and look at the actual gear rolling off the assembly lines in Section 4, expanding the product arsenal beyond the classics.
They are expanding their reach across the board right now, moving way beyond traditional handguns. For instance, they just introduced their first ever lever-action rifle, the Model 1854. On top of that, they're innovating within their Gemtech suppressor line, and they still hold a completely dominant position manufacturing handcuffs and law enforcement restraints. It's a seriously smart level of diversification.
And notice the tasteful contrast in their manufacturing philosophy here. They cleanly balance the nostalgia of their historically crafted classics line, the master engraving and those iconic profiles, against the highly engineered, custom-tuned models coming out of their performance center, which boast ported barrels, enhanced triggers, and competition-ready specs.
This dual approach is honestly a game changer. It allows them to leverage the immense brand equity of a 17-year-old nameplate, while at the exact same time capturing the modern, data-driven buyer who's looking for the absolute newest technological features. It's a brilliant way to capture two completely different types of consumers under one roof.
Of course, operating a manufacturing machine of this immense scale isn't a walk in the park. Let's look at Section 5, Navigating Headwinds and Risks, the External Environment.
As we look at the actual risk summary from their Form 10-K, the sheer volume of variables they have to manage is pretty eye-opening. A complex global manufacturing business does not exist in a vacuum, right? So forecasting demand means they have to carefully navigate an incredibly complex maze of external pressures.
Looking strictly at the data, they're constantly dealing with high inflation, component shortages, and some highly complex, shifting legislative environments that always threaten to eat into their margins. Plus, they explicitly highlight the modern need to protect sensitive digital data from cybersecurity threats, all while battling in a tight labor market to attract and retain specialized manufacturing talent. But ultimately, the SEC filings make one thing explicitly clear. Protecting the reputation of their iconic brand is just as critical as managing their physical factory output. The name stamped on the product is the ultimate driver of customer loyalty. Any damage to that reputation is seen as a foundational risk to the entire business. Which leaves us with a pretty fascinating final thought for this explainer. How will this historic corporate machine continue to balance these complex market risks with rapid product innovation in the years to come? Watching a 170-year-old brand try to out-innovate much newer competitors in such a highly regulated future is going to be incredibly compelling to watch. Thank you so much for joining me for this deep dive, and keep an eye out for our next explainer.